Let's start with the FOMC because, of course, that is one of the main items on the agenda for this week. There's lots going on this week, but we're not going to get a rate decision necessarily, or at least one that moves the rates. But what do you think Fed Chair Jay Powell will try to signal?
Good morning, Vonnie. And absolutely what you're saying is our thoughts too, that we're going to just wait to see what Chair Powell says. Because, yes, there's no expectation for a rate cut at this point. Our own in-house view is that we will probably see 2 rate cuts this year, starting September, maybe December. But a lot now depends on the inflation data because we have seen, PCE numbers, core PCE especially, which was a little bit higher than expected. These are not very worrying numbers, and definitely the inflation growth trend is down. So let's just wait to see what Chair Powell says on Wednesday evening.
Do you think he'll be as sanguine as you are, or will he try to at least seem a little more hawkish?
He's stayed a bit hawkish for the last couple of months whenever he's spoken, and I don't think that's going to change. And again, the economy stays strong. So that, again, is a great fillip for him to keep rates where they are at this point.
What are you putting as your base case for inflation ticking up again?
The worry about inflation is, of course, geopolitical issues and the impact on oil and commodities. So any kind of peace talks would be welcome. Any kind of, some of the channels which are the shipping channels, if they, the tension over there eases, that's good for oil prices to come down. Of course, we are also seeing that OPEC has spare capacity. They could put another 6 million barrels if they wanted to. So the important part for inflation is the commodity and oil story at this point.
So we'll have to watch that, but certainly the risk premium coming off oil for the moment anyway. So talk to us a little bit about the divergence between central banks, because this is the year we will get it. We are likely to see at least the ECB and likely the Bank of England move.
So the ECB cutting in June, I think it's almost a given, our in-house view and the market view also. Now, that's very good for the European economy, very good for European corporates. So we have seen already the tick up in European companies in expectation of that cut. Same for the Bank of England. Not as many cuts expected as from the ECB. So there's definitely a big difference between if you start from the ECB going on to the UK, going on to the US, and then Japan. Because Japan, of course, is in a phase where it's getting rid of the yield curve control, getting rid of the negative interest rates. The yen, of course, has not benefited from that as yet. Whether they try to do any kind of interference in trying to get the yen a little bit stronger, that's yet to be seen. So, yes, a big divergence.
What do you do with the equities portion of your portfolio, given that we are going to see central banks diverging and the ECB moving and the BOE moving this year, likely, very likely, before the Fed? Should you get out of US equities? You've done nicely if you've been in them.
It's very difficult for me to be not neutral US equities. We still see US equities as the area for growth. With technology results, which we have seen, whether it's Alphabet, Microsoft, they're still booming. You've got very high growth coming from the communication services sector as well as technology. Overall, the US economy is also doing well. So we will probably stay neutral, the US, albeit we're going to see some volatility. We're looking to add at Europe. UK, we have seen hit record highs, the FTSE, based on the fact that it's an index based of a large composition of commodity and oil. So whilst we've been neutral, the UK, I think maybe it's time to add a little bit to Europe and the UK going into next month.
What about emerging markets? So developed markets, you've just laid out there your view, but emerging markets, we have seen, plenty of outperformance in some of them, but maybe it's not time to pivot away from those ones yet?
We've been neutral China for quite some time now. The Hang Seng has had 7 days of an up movement. What's happening in China is that the focus is on manufacturing now. So when we just heard Mary talk about the fact that manufacturing PMIs have been better, and what we are seeing and hearing from the ground is that the government is focused on the 5% GDP growth target, and they're looking at manufacturing. They're not looking so much at helping the real estate companies who are in default or in terms of other flips to the consumer, because they feel that manufacturing, and when we've seen the export numbers, now again we have seen volumes tick up in terms of exports, but not value as much. So they are looking to put that manufacturing not only domestically but out there in the world, whether it's in the form of EVs or other goods. So China market has gone up. We're still neutral. Don't know if you're going to change that because not seeing other basic parameters. India we still like. India, a long-term strategic story. The election should be beneficial in terms of sentiment. Another way of playing China we see is Japan. So we might think that, if you're looking at Asia, Japan might be the better way to play China or even Europe.
Japan isn't done yet, is what you're saying. Does the weak yen help?
Weak yen is helping in terms of exporters, but it's not helping in terms of dollar-based returns. And eventually, most allocators look at dollar-based returns.